So here's the million-dollar question, right? How can you actually tell if the stock market is expensive or if it's a bargain? It's one of the biggest questions in all of finance. And, the answer is way more complicated than it looks. Today, we're going to break down a really powerful tool that's designed to give us a much clearer, long-term look at how the market is valued.
This is the question on basically every investor's mind, especially when it feels like prices just keep going up and up and up. Are we standing on solid ground here, or are we in some kind of massive bubble that's just waiting to pop? It's a huge source of anxiety for a lot of people, but what if there was a way to, take the market's temperature?
All right, so here's our game plan. First, we're going to tackle the main problem with trying to value the market in the first place. Then, we'll bring in the Shiller PE as the solution and dive into why its 10-year view is such a game changer. After that, we'll get practical and learn how to actually read the numbers. And finally, we'll talk about why it's more like a map for the road ahead and definitely not a crystal ball.
Okay, let's kick things off with the valuation problem itself. How in the world do you measure the value of the entire market? Well, it turns out just taking a quick snapshot can be super misleading.
Think about it like this. The metric most people use, the standard PE ratio, it just gives you a snapshot. It compares today's price to only the last 12 months of earnings. That's kind of like glancing at your car's speedometer. Sure, it tells you how fast you're going right now, but it says absolutely nothing about the long-term health of the engine. For that, you need the long view. You need the car's full maintenance history.
And this brings us to the solution, which was cooked up by Nobel Prize winner Robert Shiller. He created a much more robust way to get at the market's true value.
It's called the CAPE ratio. That stands for cyclically adjusted price to earnings. I know it's a bit of a mouthful, but the idea behind it is just brilliant. Instead of relying on a single year of earnings, which could be weirdly high or low, the Shiller PE smooths everything out by averaging the last 10 years of earnings, and it adjusts them for inflation. This gives us a much more stable and reliable foundation for judging value.
And that 10-year window? That is the absolute secret sauce here. It's specifically designed to smooth out all the wild bumps of the economic cycle. So how does it actually work? Well, it sounds complicated, but it's a pretty simple four-step process. First, you grab a decade's worth of earnings data. Second, you adjust all those numbers for inflation, so you're comparing apples to apples. Third, you find the average of all that. And boom, step 4, you just divide the market's current price by that 10-year average. That's it. Simple, but incredibly powerful.
So the whole point is this. A single year's earnings can totally fool you. A company or even the whole market could have a blowout year because of some temporary boom, or a terrible year because of a recession. By averaging over 10 years, the Shiller PE just smooths out those crazy peaks and valleys. It gives us a much more reliable signal of what's really going on under the hood.
Okay, so we have this powerful number. What does it actually tell us? Well, this is where it gets really interesting. This is how we use it to read the market's temperature and get a feel for what might be coming down the pike. The relationship here is honestly beautifully simple. A high Shiller PE, which means stocks are expensive compared to their long-term earnings, suggests that you're probably going to see lower returns over the next decade. And on the flip side, a low Shiller PE suggests that higher returns are much more likely. It's an inverse relationship. When the price you pay today is high, your future rewards tend to be low, and vice versa. Makes sense, right?
And history totally backs this up. Just look at the peak of the dot-com bubble back in 2000. The Shiller PE hit a crazy all-time high of 44.2, and guess what? The decade that followed delivered pretty lousy returns. Now fast forward to the absolute depths of the 2009 financial crisis. The ratio bottomed out at 13.3. And what came after that moment of peak fear? Oh, just one of the greatest bull markets in history.
Which brings us to today. Right now, the Shiller PE ratio is hovering around 33. Now, to put that number into perspective, the long-term historical average is only about 17. So, yeah. Historically, when the ratio has been this high, the average real returns over the next 10 years have been in the low single digits. That is way below the long-term average. And that is the powerful and kind of sobering message this number is sending us right now.
But, and this is a really critical point, we have to be careful here. This brings us to our final and maybe most important section. The Shiller PE is a map. It is not a crystal ball, and we absolutely have to understand its limits.
Look, the Shiller PE is not a short-term market timing tool. It will not tell you if the market is going to crash next month or next Tuesday, no way. Its power lies in forecasting the probable returns over a very long time horizon, like the next decade.
So let's just be super clear about the caveats. A high ratio doesn't mean a crash is right around the corner. Markets can stay expensive or overvalued for years. It's also true that things like accounting rules change over time, and the interest rate environment can totally influence what a normal PE level even is. These are all critical things to keep in the back of your mind.
So the real takeaway here is this. The Shiller PE isn't for predicting the future. It's for managing your expectations. It's an amazing tool that lets you zoom out from all the day-to-day noise and just assess the market from a calm, informed, long-term perspective. It really helps you ask better questions about the potential risks and rewards that might be ahead. Which leaves us with the really big question, doesn't it? With the Shiller PE signaling some pretty high valuations, you could even say it's flashing red, we all have to ask ourselves, is this time different? Are there totally new reasons that justify today's prices? Or is history about to do what it does best and repeat itself? That is the critical question this amazing tool forces every single one of us to confront. Thanks for tuning in.